You check every box. You graduate, get the job, save what you can, maybe buy a house if you're lucky. You follow the rules perfectly. And somehow, at the end of each month, you're further behind than you started. Not because you're lazy, not because you're reckless, but because the system you're living inside was designed with mathematical precision to make sure you never catch up. This isn't about personal finance tips. This isn't about budgeting harder or investing smarter. This is about something deeper and far more disturbing. The modern debt system, the one that governs mortgages, student loans, credit cards, and even the money in your bank account, was built deliberately over centuries to reward a very specific group of people. And you were never part of that group. Let me show you 5 structural mechanisms, 5 design choices embedded in the financial architecture of the modern world that ensure ordinary people stay trapped, while elites extract wealth continuously, invisibly, and legally. This is documented. The contracts exist. The incentives are written into law. And once you see how the system was engineered, you'll understand why working harder doesn't help, why saving more doesn't matter, and why the gap between you and them keeps widening no matter what you do. Let's start with the most fundamental mechanism, the one most people never question. Debt contracts in the modern economy are structured so the lender always wins, even when they lose. Before the 16th century, lending money was risky. If you loaned gold to a merchant and he defaulted, you lost your gold. The debt disappeared. The system cleared. But starting in the 1500s, European legal systems began introducing a new concept called collateralized lending with recourse. The idea was simple. If you borrow money, the lender gets to claim not just the asset you bought with the loan, but also your future earnings if that asset isn't enough. You take a loan to buy land, the land's value collapses, the lender seizes the land, but you still owe the difference. And the lender can garnish your wages, claim other assets, pursue you legally for years. This flipped the risk structure entirely. The borrower now carried all the risk, the lender carried almost none. By the 1700s, this structure had spread across Europe and into the American colonies. And it came with a second innovation that made it even more powerful: compound interest. Before this period, interest was usually simple. Borrow 100 gold coins at 10% annual interest. You owe 10 coins per year. If you couldn't pay, the debt stayed at 100 plus whatever simple interest accrued. But compound interest means unpaid interest gets added to the principal. That new total generates more interest. The debt grows exponentially. Borrow 100 at 10% compound interest and don't pay. After 1 year, you owe 110. After 2 years, you owe 121. After 10 years, you owe 259. After 30 years, you owe 1,744. The original loan has grown 17-fold, without you borrowing another cent. This is the first mechanism. Debt contracts are designed to grow faster than your ability to pay. The lender is protected by collateral and recourse. You are exposed to exponential liability. And this isn't an accident of mathematics. It's a legal design choice that was written into commercial law across Europe and America between 1600 and 1800. Now add the second mechanism. The way money itself is created ensures you're always chasing a moving target, minted as coins or printed as bills. That's not how the modern system works. About 97% of all money in circulation today is created by private banks when they issue loans. Here's the process. You go to a bank for a mortgage. The bank doesn't lend you money it already has. It creates new money by typing numbers into your account. You now have $300,000 that didn't exist before. You spend it to buy a house. That money circulates in the economy. But you owe the bank $300,000 plus interest. Let's say $200,000 in interest over 30 years. So the bank created $300,000, but you have to repay $500,000. Where does that extra $200,000 come from? It has to come from money someone else borrowed into existence. You're competing with everyone else in the economy for money to repay debt that's larger than the total money supply. This is a structural impossibility. There is always more debt in the system than money to repay it, which means someone, somewhere, must default. Not because they're irresponsible, because the math doesn't close. This mechanism was formalized in the early 20th century, but its roots go back further. In the 1800s, European banks discovered they could issue more paper notes than they had gold in reserve. They'd hold 100 ounces of gold and issue 1,000 ounces worth of notes, betting that not everyone would redeem at once. This was called fractional reserve banking. Governments tolerated it because it expanded the money supply, which enabled economic growth, but it also meant money was created as debt. Every dollar, every pound, every euro in circulation today originated as a loan. And every loan comes with interest, which means the total debt is always larger than the total money. You're not failing to keep up. You're playing a game where the rules make it mathematically impossible to win. Now, the third mechanism, and this one is more insidious because it's invisible to most people. Asset inflation is structurally designed to benefit people who already own assets and punish people who are trying to acquire them. Let me show you how this works. When banks create money by issuing loans, that new money doesn't spread evenly across the economy. It enters through specific channels: mortgages, business loans, corporate credit lines. The people who get access to freshly created money first are the people who already have collateral. Wealthy individuals, property owners, corporations. They borrow new money at low interest rates and use it to buy assets. Real estate, stocks, commodities, this drives up asset prices. Housing prices rise, stock prices rise, but wages don't rise at the same rate because wage earners don't get the new money first. They get it later, after it's trickled through the economy, diluted, and already pushed prices up. This creates a permanent lag. Asset owners benefit from price increases fueled by newly created money. Wage earners face higher prices but delayed income growth. Gap widens every cycle. This isn't a flaw. It's a feature of how money creation is structured. The people closest to the money spigot, the ones with collateral, credit access, and borrowing capacity, get richer. The people far from it, wage earners saving for a down payment, fall further behind. By the time you've saved enough for a house, the price has risen faster than your savings. You're chasing an asset bubble inflated by debt you don't have access to yet. And this cycle has been accelerating since the 1980s, when financial deregulation made it easier for banks to create money and for wealthy borrowers to access it. Between 1980 and 2020, US housing prices increased over 400%, while median wages increased about 30% adjusted for inflation. That's not a supply problem. That's a structural feature of who gets access to newly created money first. The fourth mechanism is more recent, but it's devastatingly effective. Consumer debt has been normalized, even encouraged, as a substitute for wage growth. Starting in the 1970s, real wage growth in most developed economies stagnated. Productivity continued increasing. Corporate profits soared, but median wages flatlined. Workers were producing more value, but they weren't getting paid more. So how did the economy keep growing? How did people keep consuming? Debt. Credit cards were introduced widely in the 1960s but exploded in the 1980s and 90s. Household debt as a percentage of income tripled. Student loans, which barely existed before 1970, became a $1 trillion industry. Auto loans stretched from 3 years to 7 years to keep monthly payments affordable even as car prices rose. The system replaced wage growth with debt access. You can't afford the lifestyle previous generations had on your salary, but you can afford it on credit. For a while. Here's why this is structural. Corporations and employers benefit because they don't have to raise wages. Banks benefit because they collect interest on all that consumer debt. And workers feel like they're maintaining their standard of living until the debt comes due. Then you're paying 15%, 20%, sometimes 25% interest on credit card balances. You're paying 6% on student loans for degrees that were supposed to increase your earning power but didn't keep pace with tuition inflation. You're paying interest on a car that's depreciating. Every month, a chunk of your paycheck goes to servicing debt instead of building wealth. And that interest? It flows upward to financial institutions, to asset managers, to the people who designed this system. This isn't accidental. In the 1980s and 90s, financial industry lobbyists worked with lawmakers to deregulate consumer lending, raise interest rate caps, and eliminate bankruptcy protections. The 2005 Bankruptcy Abuse Prevention Act made it harder to discharge debt even in bankruptcy. The system was deliberately restructured to make debt easier to acquire and harder to escape. You were encouraged to borrow and then trapped in repayment. Now the fifth mechanism, and this is the one that locks everything else in place. The legal and financial infrastructure ensures elites can offload their risks onto you while keeping their gains private. Let me explain what this means in practice. When you take on debt, you are personally liable. If you default on a mortgage, the bank takes your house and can pursue your other assets. If you default on a credit card, your wages can be garnished. If you default on a student loan, your tax refunds can be seized, your social security can be garnished, you cannot escape. But when financial institutions take on debt, when banks over-leverage, when hedge funds make risky bets, their liability is limited. Corporations are legally structured so shareholders and executives are protected from personal loss. If a bank fails, the executives don't lose their homes. Shareholders lose their investment, but personal assets are shielded. The institution survives, the executives keep their bonuses, and taxpayers, you, absorb the loss. This became undeniable in 2008. Major financial institutions made reckless bets on mortgage-backed securities. When the housing market collapsed, those institutions faced insolvency. But instead of letting them fail, instead of forcing shareholders and executives to bear the consequences, governments across the world spent trillions to bail them out. In the US alone, the federal government committed over $700 billion directly through TARP and trillions more through Federal Reserve programs. That money came from taxpayers. It went to financial institutions. And homeowners, the people who took out the mortgages and lost their houses, got almost nothing. About 10 million Americans lost their homes to foreclosure between 2008 and 2015. But not a single major banking executive went to prison. Most kept their jobs. Many received bonuses. This is the final mechanism. The system is designed so risk flows downward and rewards flow upward. You are personally liable for your debts. Elites operate through corporate structures and government connections that shield them from personal loss. When you fail, you lose everything. When they fail, they get rescued. And this isn't just about bailouts. It's embedded in tax law, bankruptcy law, corporate law. The entire legal architecture of modern finance protects institutional wealth and exposes individual citizens to maximum risk. Now let me show you how these 5 mechanisms work together to create a system where you can never win. You enter adulthood needing education, but education is expensive, so you borrow. That's mechanism 4, debt as a substitute for opportunity. You graduate with $50,000 in student loans at 6% interest. You get a job, but wages are stagnant. That's mechanism 3, asset inflation without wage growth. You try to save for a house, but prices rise faster than you can save because new money is being created and flowing to asset buyers before it reaches you. That's mechanism 2, money creation through debt, and mechanism 3 again. You eventually buy a house with a mortgage. Now you're paying interest on $300,000 over 30 years. That's mechanism 1, collateralized debt with compound interest. If housing prices drop and you lose your job, you lose the house and still owe the difference. But the bank is protected. That's mechanism 5, risk flows to you, protection flows to them. Meanwhile, every month you're also paying credit card interest, car loan interest, maybe a personal loan. All of that interest flows to banks, to asset managers, to institutional investors. You're working full time. You're following the rules, but a growing percentage of your income is going to service debt, not to build wealth. And the people collecting that interest, they're using it to buy more assets, which drives prices higher, which forces the next generation to borrow even more. This is the cycle, and it's not accidental. Every piece of it was designed. Collateralized debt structures were formalized in European contract law in the 1600s and exported globally through colonization and trade. Compound interest became standard in commercial lending by the 1700s. Fractional reserve banking, where banks create money through lending, became normalized in the 1800s. The Federal Reserve and equivalent central banks formalized this system globally in the early 1900s. Consumer debt was pushed aggressively starting in the 1970s as wage growth stalled, and legal protections for elites, corporate liability shields, bankruptcy restrictions for individuals, bailout precedents were locked into place through the 20th century. Each change, each legal reform, each financial innovation moved the system in the same direction. More debt for ordinary people, more protection for elites, more interest flowing upward, less escape downward. Let me give you a concrete historical example that shows this wasn't accidental. In 1980, the average American household debt was about 50% of annual income. By 2020, it was over 100%. In 1980, the total private debt in the US economy was roughly equal to GDP. By 2020, it was more than 250% of GDP. That explosion in debt didn't happen because people suddenly became irresponsible. It happened because the system was restructured. In 1978, the Supreme Court case, Marquette National Bank vs. First of Omaha Service Corp., effectively eliminated interest rate caps on credit cards. Banks could now charge whatever they wanted. Credit card debt exploded. In 1980, total credit card debt in the US was $50 billion. By 2020, it was over $800 billion. In 1976, the bankruptcy code allowed people to discharge most debts relatively easily. But revisions in 1984, 1994, and especially 2005 made bankruptcy harder, more expensive, and less effective. In 1980, federal student loans totaled about $10 billion. By 2020, over $1.5 trillion. And unlike other debts, student loans can't be discharged in bankruptcy. Ever. You can lose your house, declare bankruptcy, and walk away from a mortgage, but student loans follow you until death. That's not an accident, that's policy. Those loans are guaranteed by the government, which means lenders face zero risk. You carry all of it. These changes weren't random. They were lobbied for, legislated, and implemented by financial industry groups working with lawmakers over decades. The American Bankers Association, the Consumer Bankers Association, Sallie Mae, credit card issuers, they spent billions on lobbying between 1980 and 2020, and every major reform went in the same direction. Easier for institutions to lend, harder for individuals to escape, more debt, more interest, more extraction. This is the invisible architecture. You don't see it because it's not a conspiracy. It's a system, and systems don't require secrecy. They require incentives. The incentive for banks is profit, and profit comes from interest. The more people borrow, the more interest they collect. The longer people stay in debt, the more money flows upward. And the legal system, the regulatory framework, the political structure, all of it was shaped to maximize that flow. Now let's bring this to the present, because this system is operating right now, and it's accelerating. Since 2008, central banks around the world have kept interest rates near zero, deliberately. The stated reason was to stimulate economic growth. But the effect was to make borrowing cheap for people who already had access to credit. Corporations borrowed trillions at near zero rates and used it to buy back stock, which inflated share prices and enriched executives and shareholders. Wealthy individuals borrowed cheap money to buy real estate and financial assets. Asset prices soared. Meanwhile, wages for most workers barely moved. The result? The wealth gap exploded. Between 2008 and 2020, the net worth of the top 1% in the US increased by over 80%. The bottom 50% saw essentially no change, and in many cases declines when adjusted for inflation. That's not because the rich worked harder, it's because they had access to cheap debt, which they used to buy assets that appreciated in the bubble created by that same cheap debt. You didn't have that access. You were still paying down student loans, credit cards, maybe a car loan. You weren't in a position to borrow millions at 2% to buy rental properties or stock portfolios. The system gave them the opportunity and gave you the bill. And now, in the 2020s, this is reaching a breaking point. Housing is unaffordable for an entire generation. In the 1980s, the median home price was about 3 times median income. Today it's over 7 times. Student loan debt has crippled mobility and delayed life milestones. 40% of borrowers are in default, deferment, or income-based repayment plans, where they'll never pay off the principal. Credit card debt is at record highs. Savings rates are at record lows. And meanwhile, the wealthiest 10% own over 85% of all stocks, which means they're the ones benefiting from market gains while everyone else treads water. This is the system working as designed. You were never supposed to win. The structure ensures you borrow, you pay interest, you struggle to keep up, and the wealth you generate through that interest flows to the people who designed the game. Let me show you the numbers in a way that makes this undeniable. If you're an average American worker, here's what your financial life looks like. You earn about $55,000 per year. After taxes, you take home about $42,000. If you have student loans, you're paying about $300 per month. That's $3,600 per year. If you have a car loan, add another $400 per month, about $4,800 per year. If you're renting, that's maybe $1,500 per month, or $18,000 per year. If you have credit card debt, the average balance is about $6,000 at 18% interest. If you're making minimum payments, that's about $1,300 per year just in interest. Add utilities, food, insurance, gas, basic expenses, and you're left with maybe $5,000 per year to save, if you're lucky. That's less than 12% of your gross income. Now compare that to someone in the top 10%. They earn, let's say, $200,000 per year. After taxes, they take home about $140,000. They likely own their home or have a mortgage they can easily afford. They have no credit card debt. They have investment accounts generating passive income. After expenses, they might save or invest $50,000 per year. That's 25% of their gross income, double your rate, and 10 times your absolute amount. Over 30 years, compounded, that gap becomes generational wealth for them and perpetual struggle for you. And it's not because they're smarter or work harder, it's because they started on the other side of the debt line. Now here's where it gets even darker. The system doesn't just extract wealth through interest, it extracts opportunity. Debt limits your ability to take risks. You can't leave a bad job because you have loan payments. You can't start a business because you have no capital and no credit access. You can't move for a better opportunity because you're underwater on a mortgage or locked into a lease. Debt is a control mechanism. It keeps you working, keeps you compliant, keeps you producing value for someone else. The elites who designed the system understood that. They didn't need physical chains. Financial obligations work just as well. You are legally bound to pay. You're socially conditioned to see debt as a personal responsibility, even when the system was rigged from the start. And if you default, you're punished. Your credit score drops. You lose access to housing, jobs, even basic services. The system ensures compliance through punishment and the promise that if you just keep paying, eventually you'll get ahead. But you won't. Because the math doesn't work. The debt grows faster than your income. The assets you need to build wealth are appreciating faster than you can save. And the rules are written to protect the people extracting interest, not the people paying it. Let me give you one final historical parallel that shows how deliberate this is. In the 1600s and 1700s, European colonial powers used debt as a tool to control indigenous populations and rival nations. They'd offer loans to local rulers for development or military support. When those rulers couldn't repay, the colonial power would seize land, resources, or political control. The debt wasn't meant to be repaid. It was meant to transfer power. The British did this in India. The Dutch did it in Indonesia. The Spanish did it in South America. By the 1800s, this model was formalized through institutions. The International Monetary Fund and World Bank, created in the mid-1900s, used the same playbook. Lend to developing nations. Attach conditions. When they can't repay, extract concessions, privatization, resource access, political alignment. The debt is never forgiven. It's restructured. The interest keeps flowing. The control remains. That same structure has now been turned inward. It's not just developing nations anymore. It's you. The debt isn't meant to be repaid. It's meant to extract wealth and limit autonomy. And the system is designed so you can't see it clearly because it's wrapped in the language of opportunity. Student loans are an investment in your future. Mortgages are building equity. Credit cards are financial flexibility. But the reality is simpler. It's all interest extraction. It's all wealth transfer. And it's all by design. So where does this leave you? You can't opt out. You need housing. You need transportation. In many fields, you need education. And all of those require debt in the current system. But what you can do is see the structure clearly. Understand that you're not failing. The game is rigged. Understand that working harder won't fix it because the problem isn't effort, it's math. The system creates more debt than money. It inflates assets faster than wages. It protects elites and exposes you. And it extracts wealth continuously, invisibly, through interest. Once you see that, you stop blaming yourself. You stop thinking you just need better budgeting or a side hustle. Those things might help on the margin, but they don't change the structure. And more importantly, you start recognizing the pattern in real time. When you hear politicians or economists talk about growing the economy, through credit expansion, you understand that means more debt for you and more profit for banks. When you hear about low interest rates stimulating growth, you understand that means asset bubbles that benefit people who already own assets. When you hear about austerity or spending cuts, you understand that means cutting services for you while protecting interest payments to creditors. The language is designed to obscure the mechanism, but once you see it, you can't unsee it. It was built piece by piece over centuries by people optimizing for their own interests. And those interests were clear. Lenders want to maximize interest and minimize risk. Legal systems evolved to protect lenders. Financial systems evolved to expand lending. and political systems evolved to ensure the whole structure stayed intact, even when it collapsed under its own weight. You were never supposed to win, because winning would mean accumulating wealth, and wealth accumulation requires either high income, low expenses, or access to appreciating assets. The system suppresses wages, inflates costs, and restricts asset access for ordinary people while expanding it for elites. That's not a flaw. That's the foundation. And until enough people see it clearly, until the pattern becomes undeniable to a critical mass, the system will keep operating exactly as designed. Your debt is their asset. Your interest payment is their income. Your struggle is their profit. And every rule, every law, every financial product is built to make sure that flow never stops. If this changed how you see your own financial situation, if you finally understand why you can't get ahead no matter how hard you try, then you're starting to see the invisible architecture. Subscribe if you want to keep tracking these patterns, because they're everywhere once you know what to look for. The system isn't going to explain itself. It's going to keep telling you to work harder, save more, invest smarter, but the architects knew better. The system was never designed for you to win. It was designed to make sure you keep playing, keep borrowing, keep paying, and that's exactly what it does.